This is the story of a dividend growth company who can help you exploit your dividend income and turn this into this. As dividend investors, we want lots of dividends and we can't get enough of them. That is why we often buy dividend stocks that give us a high dividend return or yield. And that strategy goes well until it doesn't. But there's a better way to grow your dividend income fast, so you can get more of it each time. And there's no better way to explain this than to take a real life example of a company that is currently on sale and can offer you massive dividends now and in the future. For this tactic to work, you need to find a company that offers a good dividend return but not too high. And with the dividend growth stock we are about to cover in this video, you will get the best of both worlds. They offer a nice 3.5% dividend yield, and they were able to grow their dividends by 20+% in the last few years. This company also has a very reliable track record with 35 years of dividend growth. As dividend growth investors, we are always looking for gems like this one. To top that, this stock has also outperformed the S&P 500 over the last 5 years. This graph shows us what would have happened had we put $10,000 in this company about 15 years ago in 2006. In 2006, that $10,000 gave us $154 in passive income, so only a 1.5% return or yield on our money. And by putting all those dividends back into the same company and contributing just $100 per month, in 2021 we would have received more than $6,100 in dividends. That is including the 2008 financial crisis. And for those of you looking at monthly dividends, that translates to more than $500 per month. That's like a third of an iPhone each month. There's only one problem with this dividend growth stock though. Its recent share price performance looks like this, but that actually creates opportunity for us. An opportunity, frankly, I've been waiting for a while already. I started investing in this company in 2017 because the best part is that this massive dividend growth stock is on sale based on about every metric possible. If this stock would return to fair value, the orange line, you could see a return of 21.5% per year. Are you excited already to get that passive income and live your dream life of traveling the world while collecting those dividends? Well, you shouldn't be excited quite yet. Just like with buying a car or a house, we need to inspect it first ourselves before making any decisions. We need to know what the company is about, how they make money, if they will continue to make more, and we're talking about T. Rowe Price here. T. Rowe Price is an asset management company that launches and manages mutual funds of all sorts. Besides that, they also offer account management services, retirement planning, and financial intermediaries. They provide their services to a wide range of customers from individuals to institutional investors. Important for asset managers is their total assets under management, AUM for short. For T. Rowe Price, this comes down to $1.5 trillion. An asset manager generally makes money through earning fees on the amount of money managed. So less money managed due to customers cashing out or the stock market declining means less money. More on that later. Warren Buffett has made the case for investing in easy to understand businesses, bordering on boring, and T. Rowe Price fits that profile perfectly, which allows us to easily analyze and judge its performance. Since most of T. Rowe's sales are earned based on the amount of money they manage, it is quite easy to keep track of their profits. If we want to understand how a business is performing, there's something else we need to understand about that business. A company is the sum of its individual parts. Those parts have to work together to have a great business. If we want to see where a company is slacking or accelerating, we want to know what business segments it operates. T. Rowe Price operates through 4 broad geographical elements: Americas, Europe, Middle East and Africa, and the Asia-Pacific region. The company has several investment products through which they generate revenue, with the main ones being US mutual funds, over half, sub-advisors and separately managed accounts, and collective investment trusts. These products mainly hold stocks, over half, fixed income assets and multi-asset. What does this tell us as investors? That the revenue of T. Rowe Price has quite a high correlation with the stock market. Looking back at the Great Recession in 2008, we see that confirmed with declining revenues and profits. And that of course is quite concerning in today's market conditions. But you know what kept rising? Their dividends. When the market started rising again, so did the revenue and profits of T. Rowe Price. That is a sign of the kind of strong company we're looking for to give us reliable dividends. But T. Rowe also faces fierce competition. Not only from other asset management firms, but also from me and you, as passive investors who prefer to manage their portfolios themselves. One of the biggest competitors must be BlackRock, ticker BLK. Other competitors are Bank of New York Mellon and well-known brokers such as Vanguard and Charles Schwab. BlackRock is definitely the biggest fish in the pond of these three, with a market cap of 113 billion. Bank of New York and T. Rowe Price are at more than half of that. Looking at assets under management, BNY is at 2.1 trillion and BlackRock is at a massive 9.5 trillion. So both are bigger in terms of AUM than T. Rowe. But we're looking to massively grow our dividends in the future. Both T. Rowe Price and BlackRock seem to be able to do that for us, since they have very similar metrics when it comes to dividend safety and how fast. T. Rowe and BlackRock also seem to have the ability to sustain their dividend growth with high earnings per share growth, and they only pay out less than half of that in dividends. T. Rowe Price beats both of these two on at least one front though. Their dividend yield is way above their own 5-year average, indicating that T. Rowe might be on sale. By how much? We will take a look at that in a bit. Besides competition, there's yet another important factor we need to take a look at. The recent price graph of T. Rowe Price doesn't look pretty, so we need to make an educated guess about what the future will bring for T. Rowe, which of course can be difficult. Even the analysts covering T. Rowe have trouble pinning down how much profit T. Rowe Price will make in any given future year. In the last 5 years, T. Rowe has surpassed analysts' expectations by 20% each year. In 2021, T. Rowe Price recently acquired Oak Hill Advisors though, which will accelerate their push into alternative credit markets. This company has another thing going for themselves long term though. They have a strong reputation and are one of the most well-known and respected active fund managers. Most actively managed funds don't beat the stock market index. T. Rowe is the exception. If they continue to do that, more money will flow into its funds from new and existing customers. Time to dig into some numbers. The sales, profits and earnings per share all had double-digit annual growth in the last 10 years. As any good stock, they've decreased their shares outstanding by buying back shares. They have as good as no debt. A good company is also able to allocate money given to them well, measured by the return on invested capital ratio. This metric is high and very consistent for T. Rowe. By all metrics, T. Rowe Price appears to be on sale. Dividend yield is way above the 5-year average yield. Fast graph shows the price, black line, to be well below the fair value, orange line, indicating that T. Rowe Price is on sale. Finbach shows the same and expects an upside of 38% to $202. There's an elephant in the room we need to discuss though. Events such as interest hikes, the war in Ukraine, sky-high energy prices are all putting down pressure and uncertainty in the stock market. Most analysts expect the earnings per share to be down in 2022 and only minimally up in the years thereafter. But I'm not worried about it. T. Rowe has been around for over 80 years now and has been through a lot of black swan events and recessions. In their 35-year streak of growing dividends, they've survived black swan events such as Black Monday and the dot-com bubble and the Great Recession in 2008. So when the markets will start to soar again, so will T. Rowe, and in the meanwhile I expect the dividend increases to keep coming to fund our dividend profits. T. Rowe Price is an excellent dividend growth stock. There's just one problem. You can't build your entire portfolio around one stock. This video shows you yet another dividend growth stock that can offer you great dividend growth to build your future dividend income stream.